Okay, so I am now on to Chapter 7 of our series, and if you recall, in Chapter 6 I gave a brief summary of what I believe the important parts of Section 1401 were. In this particular chapter, I'm actually going to pull language from Section 1401 so that you can see it for yourselves, because it's going to give you the terminology you need of some of the important issues that I discussed in Chapter 6. So first I'll start with Section 1401. And subsection C, you'll shortly see on your screen. This section stipulates what you can and cannot make per the poverty line. Next, as you continue to read on, there's another subsection C that discusses the fact that all married couples must now file a joint return, which of course for tax purposes not all of us may be very happy about. And so again, you'll see this subsection shortly on your screen. Now further on, pages 115 and 116 of Section 1401, there's some very key terminology and definitions that are stated, such as income and families, family size, household income, etc. And again, shortly you're going to see these sections that I believe you should pay attention to on your screen. So the above is important because it sets forth how the government decides what the rules are in determining adjusted and modified gross income. The biggest problem I have with this is the fact that they are determining amounts based on incomes that aren't real. Even when we file our tax returns every year, we get adjustments for deductions and itemizations that help bring the number down to a more realistic one when determining what the actual amount of taxes are that we owe the government. Here, nothing is being taken into account. I believe, just as when we file our taxes, the amount that determines whether or not you qualify for a health care subsidy should have been based on taxable amounts, which is determined after deductions and itemizations have been taken into account. This, when applied, would have helped realistically determine what is actual in terms of people's income levels. After all, if the IRS is willing to take into account credits for ourselves, our dependents, itemizations for real estate taxes and mortgage interest, etc., why is this same consideration not being given for a government health care program? If this consideration would have been given, I believe most middle-class Americans then would not be so negatively impacted by the act as we are currently, because most of us would then have been able to qualify for some sort of credit in the exchange. With that being said, I believe the government did this intentionally. This was a way to once again exclude middle-class Americans from reaping any benefits from a program that is supposed to help us, when in fact most middle-class Americans will be forced to pay full price for health insurance in the exchange, and this was done in order to help the government fund the exchanges to begin with. Once again, middle-class Americans are going to be the ones to pay the ultimate price for everyone else's benefits. This is one of the many reasons why middle-class America is starting to disappear in this country. And again, for those of you who see this as whining because we make too much money, take in consideration the facts and figures of this. Just because someone's paycheck said that they made $3,200 in 2 weeks does not mean that that's money actually given to that individual at the bank. First, taxes are taken out both at the state and local level, and then you've got union dues or work-related expenses. Right there, a person's check is reduced by almost 23%. That's almost 1/4, people. This then leaves that individual with enough to pay part of their mortgage and second mortgage, which many of us have, car payments, utilities, groceries, gas, other incidental insurance, credit card debt, set aside money for IRA or college accounts, with an amount left over of a lot less than $100 most of the time. Now again, obviously this does not equate to the over $500 amount that many may be forced to pay for insurance into an exchange per month, because on paper it looks as though this person makes too much money in order to qualify for a subsidy. So again, the argument I'm making is they should never have used adjusted gross income. that number just isn't real. I never really actually made those funds, especially after taxes are taken out along with other deductions, and I'm not even getting credit for those. Now finally, at the bottom of page 115 and the top of page 116 of the Act, the actual definition for poverty line is given that the government is using to figure out if you qualify for a subsidy. And again, you're going to see this language shortly on your screen. Again, I know I've said it a lot, but I really would encourage everyone to look up what their poverty levels will be as determined by the above Act. There is a good website to utilize this in order to find your levels, and this website should be appearing again shortly on your screen. All you have to do is look at the chart, find the size of your family and the amount it gives, then multiply that up to 400% to determine what your threshold is in order to qualify for a subsidy. So there you have it, the actual definitions of the Act that are going to be used, that I believe are vital to all of us as they determine how much we can make, what family size and poverty levels there are in order to determine if you qualify for a subsidy. And since there are many of us out there who are under the assumption that of course you're going to qualify, because let's face it, there's a certain political party out there who has been saying, oh, everybody's going to qualify for a subsidy, so it's all going to be okay. That clearly is not the case. So as always, thank you for listening, and stay tuned for the next chapter.